Hi, everyone. This is Rob Roy of Elliott Wave Options, and welcome to the U.S. Market Update. We're recording this just after the market closed on Friday, June 23rd. So if we take a look at the chart, you can see the main thing to notice here on the SPY chart is that we have relabeled. If we go back a bit, be able to see that we had a wave 5 moving to the upside, which says, all right, are we running towards the end of this? But the algorithm has relabeled it to a wave 3. We talked about this in Tuesday night's TradeFinder, the fact that after we got above 430, we went a bit vertically. And if you've watched any of these market updates, you know that I get a little bit nervous when things go vertically to the upside. So during TradeFinder, we're talking about, a little bit of a pullback here would be healthy, even though we've relabeled into a wave 3. So if we take a look at where we closed today, very similar to yesterday, closing off the lows of the day. We did have a little bit of give back right towards the end, but still closed off the lows where the open was and just below the 10-day moving average. So again, just as we talked about, this is pretty healthy as far as any potential movement to the upside from here. Thought I'd do a quick reminder. We showed these zigzag targets last week or two. This was the big zigzag where we had that 100% extension up towards the 436 region, where we finished exactly on that target on the 13th of June. And then we also have the complex C wave zigzag pattern right here. And that shows that 438 was the 100% extension there. So you can see with a vertical move to the upside, hitting those 100% extensions, why we're having a little bit of give back at this point in time. Makes a lot of sense. So the question becomes, are we going to move up towards the 161.8% extensions on these zigzags, which is, one of them happens to be right within the wave 5 forecasted target there at 460. The other one has us a little bit higher than that. But it does look like at some point the market wants to try to get to 460. So are we going to pull back into the wave 4 first and then move up to that target? Or are we going to rally in this wave 3 following this pullback? So we had a holiday shortened week, not a whole lot of news to drive the markets this week. We had Chairman Powell do a little bit of a commentary in front of Congress. He didn't really say anything other than what he said in the last Fed meeting on the fact that they are going to plan on raising twice. The Fed fund futures has taken away the potential for a rate cut in September, pricing in those 2 rate hikes that Chairman Powell mentioned. And then the other thing that Chairman Powell talked about during his testimony, and I'm going to switch over to the chart of the 10-year while I cover this, was the fact that they're not interested in mismanaged regional banks. So they're not going to make policy to help the regional banks, which I felt was pretty interesting, especially since the fact that the 10-year spread, I'll bring that up right now, on the yield curve has moved back to 100 basis point spread. The last time it did that was when we had some issues with the regional banks. So I think Chairman Powell was aware of that, and that's what prompted that commentary. So there you can see the 2-year there at 4.8, and then you come down to the 10-year, 3.8. So there's a 100 basis point spread there between the 2 10s. It's had a 100% accuracy rate of forecasting a recession. There's still people out there saying that we're not going to have a recession. They're not believers in it. The 2-10 yield spread in the bond market begs to differ. So the question becomes, when do we have that? So when we look at rates, they haven't really done a whole lot. Going back and talking about the SPY, I mentioned that there could be some end of quarter window dressing. At this point, it looks like, well, there's not going to be any of that, but not so fast. A little bit of a pullback before some of these institutions that are underperforming. And Ray Dalio came out and said last year was the worst performing year, or one of the worst in the history of investment managers, and they're not doing much better the first half of this year. So could there be some buying into the end of the month. Well, if you're a fund manager, would you prefer to buy way up here, or would you prefer to buy a little bit of pullback moving into the end of the quarter? So my point is, I don't think we can dismiss the fact that there won't be end of quarter window dressing yet, but we'll see. The market will tell us. Maybe everybody owns NVIDIA that needs to have it. And what happens with the window dressing is the investment managers want to make sure they have the stocks that have been in the news. They want NVIDIA, the Super 7, whatever you want to call them, the stocks that had all the AI stuff involved in them that created this vertical move higher in both the Qs and the SPY. We'll look at the Qs here in a moment. I still think that we have to keep the fact that there could be one more run here towards the end of the quarter. Then we'll see what happens at the beginning of July. Maybe it doesn't happen. It's just things that have occurred in the past that are notes to keep in the back of your mind when you're looking at what decisions to make from your trading. When we look at the dollar, you can see that we had a little bit of a bounce back to the upside, and that's kind of hurt the metals. The metals are getting to a point where they just can't catch a bid. They just can't. And we don't have a 5-wave pattern in the dollar anymore. I don't really see that there's any sort of a sustainable bounce in the SLV or GLD unless we break here below 101 on the dollar. So if we can break below that level, and the little bit of a bounce here, we've gotten just a bit oversold in the dollar, makes sense. But if we can break below 101, then I think you look at GLD and SLV. But for now, I think you have to stay away from those. And I bring that up because people ask about those all the time. Just some commentary there about the metals. Now, what has been working recently is Bitcoin. So we take a look at the chart of Bitcoin, and we've got this big vertical move. As y'all know, if you've been watching this, I've been concerned about the fact that we hadn't really done any sort of retracement of this move from 20,000 up to 27,000. I don't like vertical moves because quite often they come back down. So we had this triangle here that had a vertical breakout. We retraced that one, and then we tried to break vertically here. We retraced that. Now we've actually retraced some of this move from 20 to 27,000. So we take a look here, and you can see that we came all the way back down to that wave 3 high and then bounced. But look where we are, vertically to the upside. We don't have the end of day print now at this time because the market just closed. I know Bitcoin trades 24/7. I got all that, but they do give us an end of day print for software programs such as this that show end of day charts. But we're a bit overbought. We traded above 31,000 today, backed off a little bit, but we're at like 30,800 at the exact time of this recording. So we are just a little bit below that wave 3, and I think that's constructive. I don't think you want to see Bitcoin really try to break above 31,000 when you're already this far overbought, this separation from the 10-day moving average. So let's let this calm down a bit. So the ideal scenario to me for Bitcoin is that we consolidate here under this previous wave 5 and 31,000. Just calm down a little bit, allow the 10-day moving average to catch up, and then gather some more energy and momentum, and then try to break above the 31,000 level. I think that's an ideal scenario for Bitcoin. Why did Bitcoin have this big move to the upside? Well, we've been talking about the halving, whatever you want to call it. Y'all make fun of me on the way I pronounce it in the first quarter of next year. So we're right in that 9-month time frame, which the last 3 times the halving has occurred. Bitcoin had a big rally. Is this the start of it? BlackRock has applied to have a Bitcoin ETF. Perhaps they're starting to buy a little bit of Bitcoin to put into the ETF. Maybe that had something to do with it. And then Coinbase was in the news. You all ask about Coinbase a lot, and Coinbase got a favorable ruling from the Supreme Court. We've mentioned when we've been talking about Coinbase, and gosh, it's hard to say what to do with Coinbase with all the regulatory issues that were surrounding it. That seems to be resolved now. So if we take a look at the chart of Coinbase, you can see the upward move today. Also not in a 5-wave pattern, but we held this really important level of 50, where we had resistance back at the end of the year. We broke it and tested it in January. We tested it again in March. We tested it again in May and in June. And now we appear to be breaking above it. We broke above 60 today, which I think is significant. So if we look at the 10-day moving average, not really that overbought either. So what I'll be interested to see on Monday is, can we get some follow through on Coinbase above this 60 level? One would think that, yeah, that's likely to occur with the fact that regulatory stuff appears to be behind it. We have some resistance here at 70. So Coinbase does look clear to go up towards 70, and then we'll see what happens once it reaches 70. So there could be at least a short-term trade there in Coinbase, and then we'll see again how it handles resistance at the 70 level. But really interesting stuff. Really the main news that occurred this week is dealing with Bitcoin and Coinbase. Been a while, hasn't it? And people haven't been talking about Bitcoin. They still have it on the little box at the corner of CNBC, but hasn't been in discussions. I think it comes back, especially if Bitcoin rests and breaks above 31,000. All of a sudden, you're going to start hearing all the chatter about Coinbase once again. All right, so that was the news. So I wanted to cover those first, but let's look at the rest of the U.S. markets. And when we look at the DIA, also now in a wave 3 to the upside. So as you know, in the DIA, we hadn't had an Elliott Wave 5-wave pattern for a while. So between 330 and 340, again, don't worry too much about the pullback that we've had in this holiday shortened week. We tapped the 50-day moving average on the low today, closed off of that. But we do need to get above 340 here on the DIA. It tried it here on the 13th, no follow through. Tried it again on the 15th, no follow through day. That's why we talk about these rules. You have to have a follow through day. There's a lot of head fakes in the market. So we hammer these points home week in and week out. You can't get too far away from the 10-day moving average. No security in any time frame gets too far from the 10-day moving average. And you don't like vertical moves. They tend to get retraced. And you also don't want to break a major point of support or resistance with a vertical move. And when you do break a point of major support or resistance, you have to have the second day, the follow-through day. Those are all general market rules that we, again, talk about week in and week out because they're important. They should be factored in all of your trading systems, regardless of what kind of system you use. Now, the Elliott Wave algorithm is showing a potential move up to about 355 here on the DIA, but we got to get back above 340 first. So we were in this range, in the 330, 340 range for a few months, and we got to get back above 340 before we can start talking about 355, obviously, but pretty interesting there. The Qs, I know everybody's interested in those because of the Super 7 or Magnificent 7, whatever you want to call them, of the stocks that have been driving the market higher with AI mentioned in their reports after their earnings. And you can see that holding in pretty well, honestly, on the Qs. We did come back down to 360, which I feel like is constructive because when we broke 360, we did it in a vertical fashion. Not what you want. You want this kind of move. You want to stay in this 45-degree angle. We didn't. We got to, you could even say around 350, we started this vertical move up. Do we have to come all the way back down to 350? Maybe, but we're trying to hold 360 right now. And if we can bounce from this level at the beginning of next week, perhaps we're then off to looking at perhaps 400 in the Qs sometime later in the summer. So 360 is a level to watch on the Qs. If we hold that, then I think you stay bullish. If we break below 360, then I think you got to back off a little bit because we could come down to 350 or even 340 before resuming the upward move. So on the Qs, keep a close eye on 360. That'll give you the indication of whether we're good to go with this extended wave 3 or if we need even more of a pullback first. Pretty interesting there. The IWM had really garnered some attention because it was showing a bit of a broadening of the rally that had been so confined to those handful of stocks, but it's backed off significantly as well. We had the big trading range for over a year between 170 and 190. We tightened the range between 170 and 180 for a few months, and we broke above that at the beginning of June. Got almost within a frog's hair there, if you will, an old expression that my uncle used to talk about all the time, of 190. Also in a wave 3, so we're starting to get where we had charts that didn't have 5-wave patterns, some that did, some that were in a 5-wave like the SPY was. All of these have now labeled into a wave 3. So it looks like there's higher highs to come, but how much of a correction do we need first? That's the question that we have right now. So breaking above 180, we also talked about this in Tuesday night's TradeFinder, because we were up here at 185. And we're saying, do we need to come back down and test 180? You would think so, because that was a point of resistance. Old resistance becomes new support and vice versa. And so far, that's exactly what happened. We didn't even quite make it down to the 50-day moving average on the IWM. But you would have loved to have seen 185 hold. But as I said, breaking down to 180 makes a lot of sense from a technical standpoint, because it was resistance and it hadn't really been tested since we kind of made this big vertical move up. So there we're getting that vertical move retrace. We're testing 180. That's all constructive. So we can't write off a bullish scenario just yet, I don't think. But at least the pullbacks for now are very healthy. We could get more nefarious moves to the downside, and then we change the narrative, but we're not there yet. And if we do, there'll be plenty of time to create some sort of bearish trades. Look at the last thing I wanted to show on the IWM. As you can see on the low today, we did come into this tap box. Will we relabel that at the beginning of next week and have a wave 4 here? Likely, because that's the tap box target price. And since we're within that, I wouldn't be surprised to see that. And if we could get those wave 4 pullbacks out of the way, then you feel even more comfortable about perhaps one more run to the upside. That 100 basis point spread between the two tens is the biggest negative in the markets to me at this point in time. Perhaps the market is concerned about some regional banks coming out and mentioning they're in trouble again. It's not a guarantee that 100 basis point spread is going to hurt the regional banks, but it makes their job so much more difficult. The Fed did open the lending window for the regional banks, even though Chairman Powell came out and said, we're not going to make policy based on those, but yet he created, from what I understand, it's been between 500 and 600 million has been accessed. So that's excess liquidity that the regional banks have taken advantage of. And is that enough? Now, well, we're going to find out now that we hit that 100 basis point spread between the two. Money's moving back into money markets. So from a liquidity standpoint, that's a negative for the equities markets. If you can get that kind of return on moving into a money market, do you really want to fool around with the risk of the equities market? So, still lots to talk about, but the pictures are becoming slightly clearer with all of the major markets in wave 3 patterns, at least. So really interesting stuff going on as far as the markets in general. I'll bring up a chart of the VIX for one main reason, and in Tuesday night's TradeFinder, somebody actually mentioned, and that's one of the great things about TradeFinder is we do have a Q&A at the end, and we get a lot of really good questions and comments. Somebody asked, why would you show an Elliott Wave pattern on the VIX? It's a chart, and we're looking for patterns. And when we were talking about how the VIX had tried to hold 14, but the wave 5 extension hadn't really reached a reasonable level. So now we have a really well formed 5-wave pattern here with the wave 4 at the 38.2% level, and now the wave 5 to the 61.8% level, which is exactly where you would expect the VIX to go, or any chart to go on a wave 5 after a 38.2% wave 4 correction. You look for the 61.8% extension. Can the VIX go lower, or is that going to be it? Perhaps, from a negative standpoint, the VIX needs to jump back up and test 17, just as we just finished talking about on the IWM. Maybe that occurs. We'll have to wait and see. A couple international charts that I did want to show real quick. I know y'all like to see the INDA, and we had a really nice run to the upside on the INDA, but look what happened today. So we wanted 43 to hold, had a little bit of a pullback. You look at the 10-day moving average, the negative here, a little doji, so maybe that's the end of it. But you would have liked to have seen consolidation right at 43, not the break of the 10-day moving average. So that suggests that perhaps on the INDA, we might need to come down towards 42 first before we can turn and move back to the upside, or is this wave 4 underway? So a little bit of a chink in the armor here on the INDA, something to keep an eye on. A couple other international markets real quick before we wrap things up for this Friday is on the EWG, looking at the German market. 28, 29 has been the levels that we've talked about for quite some time now. We've been in virtually a trading range between the two since January for the entire year here. A little bit of a break below, a little bit of a break above, but most of the time spent ping-ponging back and forth between those levels. We did trade lower here, but we're able to close above 28. So if you're long the German market, you're like, okay, we got to hold right here. If we break below 28, perhaps we can hold 27, but it starts to get a lot dicier on the EWG if we can't hold 28 moving into the early part of next week. And then last but not least, what a lot of you have been asking about is the Japan market, because it was looking pretty strong as well. Same thing that occurred here in the INDA, some channeling here, churning, consolidation from this vertical jump up here. But again, today breaking below the 10-day moving average. There's another little doji there. So all the way back down towards support here at 61. A little bit oversold now on the EWJ. You want to see that hold if you've been trading the Japanese market. And again, based on your questions, a lot of you that watch these are. So healthy pullback or a sign of more things to come. Last comment I'll make on the EWJ here is the fact that perhaps we come down towards this 60 level, but there's a good deal of support right there around the 60 level. Before we go, don't forget, we are on our push to 40,000 subscribers here on the EWO channel. We do the live Q&A on Fridays on the Hub Financial channel. So go over there and subscribe to that. We do a whole 30-minute session on just Q&A, asking and answering questions about the stocks that you send in. But here on the EWO channel, we do want to get to 40,000. All you have to do in order to enroll for 4 subscriptions that we're giving away to our level 3 package, which includes directional, non-directional, and sideways trades. Non-directional in our mind is the strangle, so it's consolidating to break out either direction. So it's going to be all of those portfolios. We're going to give away 4 of them once we hit that 40,000 level. All you have to do is post a comment and you're entered. And once we hit the 40,000 level, we'll make the drawing and give those away. So make sure to leave a comment so that you're entered in that drawing. And then last but not least, from the charting here, if there's a particular stock that you have interest in, you can go to the chapters feature on these recordings and go right to the particular symbol that you might be interested in. So that wraps things up for this week. Have a great weekend. Look forward to talking to you again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.